All right, good morning, everybody. So, my internet provider is doing some routine maintenance. I am currently piggybacking off of my cell phone provider's internet. So, if this is a little janky or if we lose connection, you'll understand why. Seems like it's doing okay. We'll see how it goes. I'm trying not to push it, trying to be nice to the internet. We have CPI today. We've been waiting for it all week. A little bit of a curveball out of China gave us a bit of a lift with that move in the dollar, but it's starting to normalize, and we're getting some whispers and rumors out of Japan now, which may threaten the carry trade. We'll see how that goes. The long and the short of it with that carry trade is look back to August 5. Yeah, that sounds right. And see that fantastic drop to the downside, you'll have an idea of the concern, right? Just bring up something like the VIX and consider the impact of what would happen with the markets if Japan decides that they want to raise rates. So here's August. The VIX spiked up to 64.5. You can imagine what the S&P did going in the other direction. There's August. So we were up here. Bank of Japan raised rates, smacked us down here before things began to normalize. Now they've been saying they won't raise rates, blah, blah, blah. But now, with what China just did, Japan is considering raising rates. Markets aren't going to like that. If they do it, it'll affect the carry trade. It'll hit the VIX. It'll hit the US. We'll see a response. Just something to be aware of. So we could see Japan up close to 1%, UK up a quarter. Then we start getting into our own markets, which are basically flat, waiting on CPI. We do have data coming out on the budget at 2 o'clock, but really, I don't think it's going to overshadow whatever we get from CPI today. It's Wednesday, so we have the crude report. We also have the 10-year auction at 1 o'clock. That's my baby. Pay particular attention to what time it is. These auctions, although they always show them as a non-event, as something that you shouldn't really be concerned about, I'm warning you, you should be concerned about it. Pay particular attention to the 10-year, the 30-year, and these auctions. All right, don't sleep on this. So if you want to hear a little bit more about what's going on with the dollar and the Chinese leaders, you can read about it in the European market wrap. Every day, Finance Juice does a market wrap for a market that's about to close, whether it's Asia, Europe, or the US. And then before a market opens, they'll do a pre-market briefing for those same three markets, Asia, Europe, and US. So here's the US morning session prep. There's the European market wrap. They do this every day. So it's a nice little summary, get you caught up. The thing is, Europe's not closed yet. They know that we're going to be waking up, getting ready for our own trading day, and they do this early for us. Europe isn't going to close for another 5 hours still, but they give us this early. Take advantage of it, right? Get an idea of what the hell happened while you were asleep last night. Oddly enough, we're not seeing hedging this morning. I really expected that we would. The only thing I can really think about here is that the open interest as we're getting ready to roll is low enough that the sizing of the positions that we would typically see is already done, and that there isn't enough left for them to mess with, and so they're not hedging. If we were to have changed contracts into a different expiration, then maybe we would see the market maker move up there. But since the market maker move is looking at the December contracts, if they're hedging in the March series, we're not going to see it, right? That's the long and the short of it. We won't see it because that's not what the market maker move is going to look at. It's not going to look at March. Otherwise, volume is a little light, but it makes sense because we've got CPI to see that light volume. If you come in and you see the volume that light and there isn't anything scheduled today, then you should be worried. Go hit the news, look around, try to find out why is the volume so light. Usually what you'll find is that a market was closed. Say Europe was on a bank holiday, or Asia was on a holiday, and they just weren't open, and so the volume was light. Don't take that for granted. Go look, find out why. Every once in a while, it'll be something really big like QRA, and QRA doesn't get listed on Market Watch and all of those websites that we go to. It's pretty obvious since we're flat that we're in the middle of the ADR lines. We don't have any edge towards one side or the other. And we would have to break outside of yesterday's range to hit either one of them. So right now we're just holding the line, hugging the VWAP. We're getting reciprocation. Whatever we have on one side, we're getting on the other. And that's the plan. Just hold the line into CPI and see what we get. CPI is a day where we could get a liquidity gap play. Now, I've shown that enough that I decided not to show it this morning. The idea is we're going to get some unfinished business, a really big candle at 8:30. Doesn't matter which direction the candle goes. Use a 5-minute chart, wait for that 5-minute candle to end, and then measure that chart's candle, project it higher and lower by 50%, mark the midpoint of it, mark where it opened. So we want to see price go back to where it opened. That'd be the gap that needs closed. The ADR continues to shrink. It's the same thing that we've been saying. Volatility is compressed. That should not make you feel, warm and fuzzy and safe. Volatility is low and it's missing out on this threat, the horizon, the wall of worry. If Japan raises rates and traps everybody in the VIX and we get another spike like we did last time, we're looking at the S&P down to 5,000 easy, 4,900. It would be violent and it would be swift. Today's floor pivot is below yesterday's floor pivot. That's bearish. It's completely outside of yesterday's channel. Price opened underneath that pivot, which is also bearish. We didn't hit the pivot yesterday, so that's an MDP to the downside, and that is bearish. We haven't hit today's floor pivot. That's bearish. We got a lot of bearish bias. Now, having said that, since we're supposed to hit the pivot about 80% of the time, the base case argument is that we'll hit it. it's very likely that we'll do it in the pre-market when we get CPI, right? We get some violence. Maybe we spike both directions and we tag that thing. Either way, it's an MDP yesterday and we're building one today. If you want to know more about what a missed daily pivot is, you can just go to YouTube, type in missed daily pivots. You can learn about it. It's a trade strategy that I don't trade. But if you learn the strategy, then you can just use that as a part of your analysis. And that's what I did. I learned it. I like the analysis that comes from it. I just don't trade the setup. This is our S&L levels for today. So when it comes to support and resistance with these floor pivots, we always need to be concerned about how far away they are, because over time, when we have periods of time where we're just going sideways, that's what we'll end up with, is a very narrow, compressed set of lines. You can see on December 4th, for an example, they were really narrow. But take 11/27 and they were really wide, right? Well, if they're really narrow, we can get to an R2 or an R3, S3 really easy. It doesn't take much because everything's so compressed. But if they're really wide, then we'll struggle just to get to an R2 or an S2. If you look at what we have right now, the lines are pretty close together. It won't take much to get to the R3 or the S3 today. The little bit of assistance that we were getting from this volume profile's high volume node area finally failed, and we broke down underneath it. Now it's going to act as a resistance if we try to get back through it again. Breaking our own low here at 60.39 offers 60.20 and this point of control from 2 weeks ago. If that fails, then 59.20 doesn't seem unreasonable at all. To the upside, if we can get back through our own point of control, we can move into 6100 with gravity. So we just got to get through this 60.64. The problem is it's not just this week, it's also last week's. It's a high volume node. Just think of it as unfinished business. All right, the call wall is still in the same spot. We're underneath the volatility trigger. The put wall is now underneath 0 gamma. If we break our own Globex low, 60.11 is on the table, and 60.11 is the cog line. It's also the 0 gamma level, and that is our point of no return. We got to hold above that level. So this is last week's low. You can see both of these candles, they're really close to being the same thing. We're We're not IX10 yet on the weekly. We're just inside week. And this is what we have to change. We have to get out of this week, preferably to the upside on good data. But if we break through last week's low, then aiming for the 10-period weekly moving average is not off the table. That gets us around 5950-ish. So 6011 and then 6,000, cut through that into 5950. I don't think we'd do it in a day, right? 5950 in a day, it would have to be some pretty negative news. Yeah, it'd have to be pretty negative. 10-day, 30-minute volume profile with TPO. They're both still across the high at 6095. But we're building out a new high volume node at that 6062 area. And we're not going to see it decrease off the left side for another week at least, which gives us time to build it up more if we happen to run back up into that area today. So the point of control that we have is very likely not going to move anytime soon. And if it does move, then 6060 is probably where it's going to end up. The question is, will we still be here when it gets here? If it is, we can use it as a springboard to help get us through that 6111 high. Otherwise, it'll trap us underneath it and we'll have something else to fight to get through. So the VPOC that we put on yesterday was hit. Worked out really nice, by the way. It happened to cap yesterday's high. Since we don't need that line there anymore, yesterday it also gave us a new VPOC. So 6062. If we happen to break to the upside, that would be a target or a goal destination to aim for. Otherwise, you can see in the overnight, we've had a really clean distribution. That's a classic D-shape bell profile. It's exactly the textbook. Doesn't get any better than that. And no red flags, nothing stands out versus the TPO profile and the volume profile. Imagine that. We made it to the edge of the weekly expected move, which happened to also be an options level, round number 6050. And that's where we paused and stalled. Now, I've built trading strategies over the years that focus on these weekly expected moves, especially when it comes to using options. A good rule of thumb that I like to do is if we get to the edge early enough in the week, take a trade in the other direction. It has a reasonably decent chance of success. The issue is there's a difference between, hey, I don't think you're going to go down anymore, and hey, I think you're going to go up now. We can stop going down and still not go up. So rather than, say, buying a call up here, you could consider perhaps selling puts down here. I like to do it at the money. That way I'm selling something and getting, say, half the width in credit. If you even sell something in the money a little bit, 60-60 or a little higher, probably better to look at the SPX if we're going to talk options for a minute. The SPX is going to open, at least at the moment, it's going to very likely open near this weekly expected move. But if we're talking about taking the other direction, selling a put at the money or even a little in the money, it's a cash settled product, European style option, so you won't get it assigned early, you can get more credit than 50%. So, the smallest you can make that credit spread is $5 wide. Maybe you can get $3 in credit, 3.5. So you're risking 150 to make 350. Either way, we're on the edge. The base case argument is that we will close this week inside that range because that's what we do 80% of the time. I'm not sure if Robinhood has SPX or not. It's an index, right? The CBOE is kind of touchy and they want their money. And every broker that I know that offers the SPX defers to the CBOE on the cost. And it being Robinhood being a free broker where there's no cost, I don't know that they'll have it, right? Although they just did that big Legends update and now they offer futures and all kinds of stuff. So maybe they have the SPX. That's cool that they're continuing to grow and upgrade. You can do it with SPY too, right? Except, well, let me rephrase. There's an XSP. This is the size of SPY, but it's still European settled, so there's no threat of assignment or early risk or anything like that, right? This is just like the SPX, only the size of SPY. The problem is it's not as liquid as SPY and SPX. I mean, it's probably more liquid than a lot of stuff out there, but nothing compares to the SPY, right? Not in liquidity. So we're on the edge. If we break really expand, this is where we get into that short-term, dealer gamma levels, and we start focusing on, are we in positive gamma or are we in negative gamma? Because if we're in positive gamma and we break down, they'll buy into it and they'll just bring us right back up again. On the other hand, if we're in negative gamma and we break down, they will sell into the selling, which can exacerbate the move and significantly increase the speed and the distance that we travel to the downside. Take us back, to that August situation, for an example, when we broke down on that Thursday into Friday and then, into the Monday of the next week and down, we just kept going down. Or back here in September when we broke down and we expanded for the whole week to the downside. We're still looking good when it comes to the 10-week. Everything is fine. We're just kind of holding the line. You don't want to get too close to it. Less than 1% makes me a little nervous. It makes me think that we're going to just gravitate on down to that 10 and tag it anyways. But if we're still holding more than 1% above the 10-week, I think we're fine. We won't get drawn into it like gravity. Looking at the 10-day, we're there, right? And we've been there on previous days. We just didn't close there. So we can see multiple days. If I kind of zoom in a little bit, you can see it's little nubbies. We're there. We've reset on the daily. We're looking to see what we're going to do next, but it's a wave. So if we do cut to the downside, It could be a small wave before a move back up, or it could just be these little waves. There's really no reason to consider that we would get some big, nasty, deep 2022 style market at this point, right? Not with what the Fed is doing and everything else. But like I was talking with somebody yesterday about, when it comes to the market, you know, a typical normal pullback is kind of, we look for them, right? We want them. These are times where we get to reset our trades and take new longs. And a good one is a 5 to 7% pullback. Oftentimes we get less than that. We get maybe a 3% pullback. So I marked out a couple of these here, you know, especially in August when it got really nasty, but we were already pulling back anyways before Japan raised rates. So at 3.5, 3.25, 5%, 10. Are we due for another pullback? Yeah, it does. I think the cycle's speeding up a little bit. These pullbacks are coming a little quicker, a little quicker, a little quicker. It's not necessarily a good thing or a bad thing. But if we get a pullback, let's just get it done and get it over with. It's not implying that we're going to turn into, you know, another one of these 2022 years where we spent the whole year struggling to come back out of it. It's just going to be a pullback if we get it in the first place, right? Anything more than, say, to the 20 period moving average before we just turn it around and start running back up like we did back here. All right, so watch the clock. Keep your eye on what's going on with the news today on Japan. Got the auctions at 1 o'clock. Other than that, there's really no reason to try to run through the screener. Anything that's already up or down this morning is going to get rearranged once we get CPI. So there's no reason to dig too deep into that. You see the sharp move on Japan's news. Watch for that to flip, right? That'll be a bit of a warning or a heads up signal. Got the dollar more than 106.5. Using a swag level on the dollar is very likely a better choice than looking at, is it up, is it down, how much is it up or down? At this point, let's just keep it above 106.5. If that breaks, stay above 106. I think things start to get a little rowdy today if it's under 106. To the upside, shouldn't see more than, say, 107.25. Gets above that today, yeah, things will get nasty. The VIX futures, you know, we're underneath that 10, and this could be just a reset. We stayed on here basing, but it's likely that we're going to see the VIX cross back above that 10 and we start a surge signal. Surge signal is days into weeks, not just a single day concept, but it does imply that we're going to start seeing a higher volatility before January gets here. We're getting a 310 cross on the ES to the downside, point of no return on that. If we continue to expand to the downside, we're going to have a 310. That's your surge. It's a negative bearish surge on the ES. NASDAQ's not there yet. 310 isn't crossing. So if we're going to get a reset and move higher, then it needs to do the thing. Otherwise, 3 to 5% pullback would be the base case starting estimate. That's what I got, guys. Be careful, be safe. I'll see y'all tomorrow.